Our next question comes from B. I hope I pronounced it right, spelled B-H-E-E. I'm a big fan of your podcast, and I never miss listening to an episode, and I've shared it with a lot of my friends. Before I jump into my question, I want to share my financial background. I'm 42 years old, and my wife and I take home $325,000 a year. We have an $800,000 home with a mortgage of $250,000 left at a 1.65% interest rate with a 15-year fixed mortgage. We have about $550,000 invested in our 401ks, $50,000 in our HSAs, $350,000 in our bridge account, and another $110,000 in cash sitting in our bank. We have an investment property worth $360,000 with a $270,000 mortgage on it. It's leased for 2 years, and it brings in about $2,400 per month in rent. Now, my question is this. We want to buy a new home for personal use, which will cost us $1.1 million. Is it good to buy this house with a 30-year mortgage, as the house will likely be ready December 2025 or 2026 with a 10% down payment? Or is it a better idea to sell our current home of $850,000, take the $500,000 of profit, and then use that as our down payment? Or is it an even better idea to hold on to our current home, use it as an investment property, and lease it for $3,500 to $4,000 per month? You guys have my whole financial picture, so please let me know your thoughts. Robert, you want to kick this one off?
Yeah, I love it. This is pretty complex, but let me take a stab at it. I think, personally, in your situation, being high earners, you're always looking for write-offs. You're buying real estate. You're adding it to your portfolio, so that gives you some balance against your income. But in this situation, I would keep the $800,000 home. You have a ton of equity in it, and you have a very low interest rate. I would turn that into a rental as well. I think having $110,000 in cash is way too much. And based on how you set it, cash in bank, I don't think you have that in a high interest account. So that's a little scary to me. So I would use the cash, some of that cash, towards the new home. I would keep the current home, make that a rental as well. So then you have the two rentals working for you. And because you're in such a great equity position on both properties, I personally wouldn't sell them. Looking forward and having that high capital appreciation, which it seems you have on these properties, I would want to keep them, letting them grow, letting me gain more equity in those properties, and then worry about it again down the road, maybe in 2, 3, 4, 5 years, because you just don't want to be in a situation where you're taking all these tax hits all at once while you're buying the new house, but also giving up such a great situation with that 1.65% mortgage.
Oh, Robert, I'm torn. I'm so torn right now. So let me just walk you through my brain. You have an $800,000 house, $250,000 mortgage. That's $550,000 of equity you're sitting on. Sometimes Robert and I would call that $550,000 dead money, considering how quickly the house is appreciating or not appreciating. So if you keep the $800,000 house and you use it as an investment property, you are essentially saying, I am paying $550,000 of my hard-earned cash to earn $3,500 per month in top-line rental income. And I ran the numbers on this house. I could be wrong here, but I think your all-in mortgage cost at this 1.65 rate for your 15-year fixed is around $2,000. So if you have a $2,000 all-in cost, that means you're profiting about $1,500 a month in rental income off this $800,000 home. $1,500 a month is about $18,000 a year. So you're getting an $18,000 per year cash flow against your $550,000 investment, which is only 3%, a 3% yield on your money, which is why I'm going to lean towards selling the home, take that $550,000. I'm not a tax accountant, so I don't know the tax situation of selling this home, but assuming the taxes aren't terrible, you now have $500,000, $450,000 that you could do a couple things with. The stock market's up 60% over the last 2 years. 60% of $450,000 is $200,000, right? I just think about the opportunity cost here of holding on to that home despite it being at a 1.65% interest rate, which is incredible. It's just so much money. So if I were in your shoes, you guys already have $900,000 invested in your retirement accounts and your bridge account and everything else. So you're good to go from an investment perspective. You guys are going to continue to build this portfolio. You all want to now, you're in your 40s. You want to have this forever home, this dream home. It seems like, talking about be ready by 25 and 26 seems like maybe you're building it. Maybe you're having it custom built. If I were you, I would take a portion of this 450,000, 500,000, if not all of this 450, 500, and use it as a down payment on this $1.1 million home. Maybe you take, much less, right? You mentioned the 10% down. So maybe you do only 110,000 and invest the rest, because I think this is important for everyone. And I do this myself with my own rental property and how I kept it, right? Because if you are saying, I'm keeping this property and using it as a rental, from the outside in, you are saying, okay, would I have $500,000, the conscious decision of having $500,000 tied up in this to only make $18,000? That's what you're doing here. Just like if you sell it, you're making the conscious decision of taking that $500,000 and parking it in the markets and having it double every 7 years. So just got to understand the opportunity cost about what the questions are that you're asking and, how this all shakes out. But I would use some of that money, go buy this $1.1 million forever home and enjoy it. You guys are making a ton. You've got a big portfolio and you deserve it. Congrats.
So here's one more thought process to add to Austin's math to help you decide. Let's say this house, we don't have the term of how long you've had it to get all of this equity, but let's assume right now that your capital appreciation on this house every year is 6%, and you make that 3% based on where you're at right now in Austin's math. You're at a 9% return. It's not the same. It's a little different because it's not in stocks and ETFs. It's in your home. But one thing to look at that I would add, just one final point, is right now, mortgage rates are high. So a lot of people are sitting on the sideline, and we thought with these Fed cuts, we would see mortgage rates drop. They have not done that yet. So one way you could look at this is sell the house, but just not yet. I would wait until the market is more favorable and it becomes a buyer's market, in their opinion, because rates are down, because I believe you'll get more money for the house then and be able to capitalize as much as you can on the sale. So it's always going to be a slippery slope because right now the stock market and the crypto markets are ripping. So having that $500K would be great. But then also, you're not in a situation where you're going to get max value for your house, I don't believe, given the current environment for mortgages. So that's just one last thought process.